Okay, everyone, this is Jose. I am reconnected using a different technology this time. I believe things should be more stable in the second attempt. Please sound check. Please confirm to me that you hear my voice. That would be greatly appreciated. Okay, wonderful. Then wonderful. Thank you so much, guys. Very good. So let's get started. Okay, a little bit of delay with this initial technical issue. I was kind of expecting it, unfortunately, but hopefully now with this other method I am using is going to be okay. Okay, guys, just for you to understand the origin of this technical issue, I am broadcasting from China. As you probably know, YouTube is blocked by firewalls in China. So obviously I need to do a little bit of magic for this to be live, and reach you during this time that I'm gonna spend some time here in this amazing place in the world. So anyway, I believe everything should be stable now. So let's begin, my friends. So again, 16th of June 2019. Welcome to the Get Together Sharpening session. My name is Jose Blasco. Happy Father's Day, Lisa, wonderful. And disclaimer as we begin the session, the following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through a demonstration do not indicate in any way the results you may receive when using our products. Perfect. So we are ready to begin. And here is our beautiful setup with TradingView, as well as our beautiful TradeStation, as well as our beautiful notes from last week, where we started talking about important considerations when it comes to doing long-term investing or long-term trading, which it's kind of the same, but at the same time is not exactly the same, depending on how you approach it, depending on things that are things that are as critical as simply the amount of capital involved. Okay, it's not the same to do, a trade that lasts 3 weeks with $2,000 versus doing a trade that lasts 3 weeks with $2 million. It's not the same, even though it's 3 weeks. Probably if you got $2 million on the line, probably you need more diversification, you need more control over correlations, you need, you get my point, isn't it? So again, longer term trading or investing, it's anything above and beyond intraday. But with all the considerations that we added last week, you could understand at this point that there are, in fact, many different ways on how to approach long-term trading or long-term investing, isn't it? You could manage a portfolio with stocks only, not using stops because you collect dividends. You could manage a long-term portfolio without stocks at all, with all options and only options. You can manage the long-term investing with ETFs because stocks carry risk of bankruptcy, and with ETFs you basically get rid of that problem. Well, again, I'm not going to repeat everything I said last weekend, but if you missed it, make sure you go back and you rewatch it, because it's a session where basically I went over certain thoughts and concepts that are really critical. Okay, it took my time. Okay, last weekend I was not rushing at all, and it's a session for you to listen or re-listen, whenever you have the time to be, relaxed. Okay, and you have a couple of hours or a little more in front of you. Okay. To build a strong foundation. Okay, but this week is going to be more interesting because we're going to get more into the action, right? The how we do it, the how we implement it. Okay, and again, of course, the how applies to many different things, and I'm going to have to provide multiple different types of answers. Okay, so let's begin. Okay, first with repeating something I said quickly last weekend. I want to now make it a strong rule forever. which is the use of the time frames. Probably you remember that last weekend we went over the table I am about to share with you, this table, okay? We went over this table, okay, and we talked about how to use it. We had the common time frames, and we talked about the common time frames for the longer term traders or investors will never go below daily, okay, and then you also have the weekly, and then you also have the monthly. Those were the common time frames, and then these would go together edge time frames, where if you were to use minutes, okay, if you were to use minutes when it comes to edge time frames, you would focus on the 55, the 144, and the 377, okay? Remember, we also talked about the range charts, which those apply to Forex only 4X, okay? And then if you wanted to also use reactive timeframes, you may be a more conservative type of investor or trader, nothing wrong with that. So then the reactive timeframes to be used would be 21, 55, 144. And if you were to use Forex, you can also, optionally, if you choose to, use range timeframes of the same values, 21, 55, 144. Okay, this is if you use a platform such as TradeStation that allows you to input whatever timeframes you want. This is also related with, this is also possible with TradingView if you have a pro plan. Because the pro plans with TradingView allow you to customize your timeframes, okay? If you're using a basic plan with TradingView, well, then you will need to use the timeframes that are located on the right side of the screen, which are more or less the same. They're just a little less, less of an edge, but still okay. Okay, so instead of 55, you would use 60. Instead of 144 to 40, instead of 377 daily. It's similar, okay? But obviously, the combination on the left is supposed to be more powerful, okay? So this is the time frames, okay? So talking about how to do your long-term trades, your long-term investments, the first thing is to be clear on the time frames to be used. And sorry, let me repeat that. The first thing is to be clear on the time frames to be used. And on top of the time frames to be used that you have identified, then what you would do is to add the rules and the steps, the very same rules and the very same steps that we utilize when we do intraday trading, okay? If you think about it, we got 4 steps, isn't it? So the first step is for you to identify the side in which you should trade. Should you be young? Should you be long? Should you be short? Should you do nothing, okay? So you identify the market environment. That's the first step. Second step, now that you know what you should be doing, you are now looking for where the target should be, okay? Because the targets are located in different places depending on the environment, isn't it? If it's a strong trend or a weak trend. Once you know what is the market environment and what is the trend, then you go step 3, look for that entry, which is going to be a UFO lining up with an average. And number 4, then you place your stop, okay? Which in long term, that's number 4, depending on how you approach it, you could actually skip it, okay? So as you can see, there are multiple things that we need to discuss, okay? And by the way, I just told you about those steps just to be a little more visual. Let's pick a stock, whatever stock, okay? For example, we have JCI in a 55-minute time frame here, okay? So in this particular scenario, which by the way, we planned this trade the other day, but let me very quickly rephrase it so everybody's clear on the methodology. In this case, we're using the 55-minute time frame as edge and the daily as common, okay? So if you look at TradeStation here, what do I have? I have the daily time frame as common, and I have the 55-minute time frame as edge, okay? And what do you do with the common time frame? You look at the market environment, and what do we have? We have a close above the average with a DMI to be green. So what is the market environment? Is a strong trending market. Okay, and therefore, what should you do? Well, look for the target, okay, using the weekly time frame, not the daily. Okay, so you would now come in here, look at the weekly, okay, and activate your UFOs, okay, and this red UFO above, located at 44.92, that would be your target. So 44.92. That would be your target. So you know, step 1, you should be planning on longs. You know, step 2, your target is 44.92. What is step 3? Find the entry. Ideally, you will want to find a green UFO lining up with 39.47. So what do we have at 39.47? We got nothing. Okay, we don't have a UFO around 39.47. But again, not too concerning. Why? Because when the stock goes down, okay, the average is likely to go down by a little bit. Okay, so a little bit instead of 39.47. Maybe is 39. Okay, and that UFO, the top of this UFO on the edge time frame 55, the top is 38.86, which is almost 39. And in this case, because it's stocks, and you remember probably me saying many times stocks are fragile, so because it's stocks, I don't need to be perfectionist. That would be a good enough entry for this trade, even though maybe the average is still a little higher when you get to the UFO. It's fine, because again, when we trade stocks, we are not relying on the stock itself. We are relying on the stock itself up to a certain amount, but we are also relying on the broad market. The broad market could be the S&P, could be the Nasdaq, could be the Dow Jones, depending on which stock it is. As a rule of thumb, if you wish, the S&P, it's always a good one to be picked as the broad market, and therefore we are relying on the fact that that stock may have UFOs, which is very good, but on top of that, probably the S&P will also have some UFO, and therefore if this UFO doesn't work and that stock goes through that UFO without bouncing and goes to the next one, well, guess what? The second one is even more likely to work now, because now you got more buy orders, okay, exhausting more of the sellers, but on top of that, because price went deeper down, odds are that you are hitting some UFO on the S&P. And if that's not the case, okay, and it keeps going lower, well, now it's even more likely to bounce. Why? Because it went so low, removing so many of the sellers. So if most of the sellers have been removed because they sold to the buyers that were in those UFOs, if most of the sellers have been removed and no one is left to buy, what's going to happen to the stock? Well, it's going to go up. Okay. On top of that, the lower it went, the more likely it is that you will end up hitting some UFO on the S&P. So again, when dealing with stocks, because stocks are fragile in the sense that they are so dependent of market indexes, market sectors, or even stocks from the competition. So because of that, it is not imperative like you would do with futures or forex. It is not imperative for us to be too precise with the location of those UFOs relative to where the moving average is. As you can see, in this case, for two candles, 1 and 2, price went clearly below the average to finally go nicely above. Okay, why is that? Well, it could very well have been, and actually very, very well, that could have been the case, because a few days before, it went below the average and came back up, and then came back down, and finally it went, right? So if you think about this price action, it could very, very easily be price coming to a UFO, bouncing, coming back down to that one, or maybe the next one, to finally go, right? So again, that's the type of flexibility, if you wish, that you want to allow to yourself when you trade stocks. The last thing you want to do is to be too rigid, because you could end up missing those trades. Okay, so just because you want the average to line up perfectly with a UFO and all those things, so again, we are just going to use it as a reference to simply not to buy too high or not to sell too low, and that's good enough. Again, let me repeat myself. In futures of forex, you would never do that. In futures of forex, you want to be very precise. Okay, why? Because forex or futures, okay, I mean the S&P futures, okay, it's a major market. Crude oil futures, it's a major market. 10-year note futures is huge, right? Where Johnson Controls, in this case, is such a tiny company. I mean, it's not like it's a tiny company, but if you think about it, in the market, you got 9,000 stocks. This is only one. And on top of that, the market is 3 times smaller than futures, right? The equity markets. So in the end, it's okay to call it tiny. And that's why I keep saying stocks are fragile. So we always need to keep this in mind. And I remember last Thursday, I was quite intense on this concept, and today one more time, and that's because it's important. Okay, guys, so keep this in mind forever. Okay, and that's one of the reasons as well why there are many times where I would suggest to take certain trades without the use of a stop, because using stops in stocks, being fragile, is often the recipe of being stopped out, and then 2 days later you see the stock move your way, and you are left with this poker face watching it, and pretty bitter taste, if you wish. So the idea, of course, I'm not saying trade the stocks with no stop and hope for the best. I didn't say that, but with the use of options, with the use of ETFs, and other techniques that we will be learning, you could certainly mitigate the risk, but without having to need a hard stop, right? And therefore, you allow yourself for that flexibility that I keep talking about, since a few minutes ago. Okay, Orlando, question: should we develop a stop scanner based on trading parameters and another one with fundamental parameters? Well, you're reading my mind, Orlando. We're gonna get those scans to version 2 today. Okay, and you're gonna love them. Okay, because we're gonna have all of it built in those scanners. Okay, in a way that is gonna be very, very powerful. Okay, as you will see later today. So we'll build the scanners together, and feel free to take notes, of course, but later as well, I'll create a file, and whoever wants the scans, I'll be delighted to then email it to you guys if you guys send us an email. Okay, cool. So anyway, so let's keep working on all of this. So methodology, right? So the methodology, okay, when it comes to doing long-term investing, implies that we're going to use those larger time frames. Okay, and then what? Then we apply the same steps that we apply for intraday trading, okay, to this particular collection of time frames. And therefore, I just gave you a quick recap of how the methodology would be to trade JCI in that case. Okay, so before I keep going, just want to make sure that everybody's with me. So please give me some confirmation that it's clear in your mind, and you got it, and up to this point you are with me. Absolutely, Orlando. Yeah. Maybe we should add, Orlando, great and modest minds think alike, because I'm just realizing that the answer I gave to your written note was not too modest, and I didn't mean it that way, but it did sound that way. Okay, so maybe starting from now on, we'll say it like that. Wonderful, cool. Okay, so now we're going to use the larger time frames. We're going to use the larger time frames. Stocks, ETFs are fragile. We talked about that. Okay. Now, again, trading hours. I talked about it the other day. I want to remind you one more time about this. Every time you are about to use this set of time frames, every time you apply it to equities or any other market that does not trade 24 hours a day, okay, when it comes to your edge time frame, you always need to consult, double check with your trading platform. And again, for example, in this case, TradeStation has more functionality than TradingView to do so, even though TradingView it's pretty cool as well. But again, TradeStation does allow you to look at the pre and post market data as well, separately or combined with the trading hours market data, right? And the beauty of this is that, again, coming back to the concept that stocks are fragile means many things. It also means that different stocks are traded by different market participants. And those market participants, when we talk about investment banks, hedge fund managers, big institutional players, those guys, okay, they may trade those stocks in different ways for different purposes with different strategies. And therefore, sometimes those institutions, they will have the tendency to cancel their orders if they don't get filled during a period of time. And therefore, you will see stocks, for example, JCI, providing a performance metric of 54% when using regular session data, where when you switch to pre and post market, you get to see 48%. In other words, the pre and post market orders that are added to JCI, if not filled, are canceled. Okay, how do I know that? Well, I know it because of the stats. If they were not canceled, you will get the same stats that you would get with a regular session or better. But the fact that you got worse performance metrics tells you that many of those orders are not being executed, and the only reason why they're not being executed is because those orders are removed. Okay, so you had on-field order, but they were removed, so you don't have on-field orders anymore. So what should you do? And again, the reason why I'm talking about this again is because it's critical, number one, and second, it's different for every stock. Every stock is a different story. You look at JCI, that is giving you better results if you ignore pre and post market. Okay, but then you look at other stocks. For example, let's say, I don't remember by heart with Facebook, but I'm just trying Facebook. Facebook is giving you 55%, almost 56% with the pre and post market data. If you do regular session, what is it going to be? It's 52. It's worse. So what does that tell you? It tells you that even though with JCI is looking clearly like on-field orders are being canceled if they were placed and didn't get filled during pre and post market hours, where with Facebook is the opposite. Okay, the orders that were placed pre and post market are working just as well or better than the orders that were placed in the marketplace during regular trading hours. So in other words, when doing your step 3, which is find your entries lining up with the moving averages using the edge timeframes, and those particular 55, 144, 377, or the ones on the right, 60, 240 or daily. Well, obviously not for daily because there is no pre and post market, but for all the other minute timeframes, you always need to have that one extra step, which is not needed in futures and Forex, which is change your trading session from regular session to pre and post market and vice versa to make sure that the trading hours that you have selected in your chart are producing the best results. So now you have UFOs that are likely to produce the best results lining up with the average, okay, in an uptrend, blah, 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 and that's going to really help, okay? So make sure you do that extra step, okay? So talking about the how to do the long-term trading, again, use the longer time frames, okay? But remember, stocks are fragile, so every stock is different when it comes to trading hours and reliability of those on-field orders. So you have to do a manual check, okay? You need to do a manual check to find out, what's best, right? And then again, we talked about that earlier, okay? Many times you will avoid using stops, okay? And this is because of the fragility of those stocks, okay? So now, how do you avoid stocks? Let me say that again. How do you avoid stops, okay, without putting yourself at crazy amount of risk? Okay, well, you basically have 2 ways on how to not to do something crazy, okay? So the 2 ways on how to not to do something crazy, because not using stops, it's crazy, okay? So to avoid the craziness attached to not using stops, okay, option number 1, you would use ETFs, okay? Why? Because ETFs may move against you, but they will never go bankrupt, where stocks could go bankrupt, okay? And ETFs pay dividends. So if an ETF was to go against you, even though if it was to move against you a lot, it's not a good news. But in the context of a diversified portfolio, I mean, if this is the only trade you are executing, obviously you have to use stops. But if you are executing ETFs in the context of a diversified portfolio, and one of those ETFs moved against you significantly, it's a bad news. I'm not going to say it's a good news. It's a bad news. Actually, it's pretty bad. But while this is a bad news, that ETF will not go to zero. That ETF someday in the future will come back to whatever price that was. And in the meantime, every quarter you will receive dividends. So it's not ideal, but in the world of a passive investor, it could be okay to keep those positions open, waiting for that market to come back to you sometime, even though it could be a long time later on for that ETF to come back to you. Okay, but again, in the meantime, you are collecting dividends. And I'm not saying you're going to get rich doing that, but it's better than nothing. And also careful for international traders, that many of you are, because dividends has withholding tax in the States. So they would charge you 30% withholding tax. So again, it's not ideal. Okay, you probably know me enough at this point, if you have been with me in the sessions, where you know that I prefer by far using options, okay? And knowing that if a market goes against me, well, yeah, so the most I can lose is what I pay for the options, okay? And I'd rather lose that lesser amount of money and then utilize my capital in other trades, because that one has been proven to not to be a good one, instead of staying the trade just to collect, 5% a year if I'm lucky on dividends, pay or, be withheld 30% tax. Yeah, someday it came back and now I'm happy, but in the meantime, that money was not really producing much. So I personally prefer to use options. When you buy a call or when you buy a put, okay, the most you can lose is what you pay for the option. So that puts you in a pretty serious situation where a market could go against you. That's bad. But now, from that time until the expiration date, which normally we give ourselves extra time, isn't it? So now you are giving the market the opportunity to come back to you. In other words, if that first UFO fell, okay, and the second UFO or the third or the fourth UFO is the one bringing the market back up, you just gave yourself time, thanks to the options, for this to happen. And if it never happened, because it was an important change of direction, and it never happened, well, the most you lost is whatever you pay for the option. So now you could avoid using stops, knowing exactly how much you're going to lose before that happens. So you are effectively managing your risk, okay, while you are giving yourself the flexibility of knowing that, okay, if that UFO didn't work, the next one will, or the next one, or the next one, in the context of a trend, in the context of the fact that the S&P got other UFOs in other places, etc., etc., etc. And hopefully you get some bounce and you can get out at break even or a small profit, even in cases when the market went against very, very heavily. Okay, and again, I'm just going to mention it because it's fresh in our mind. If you are attending the get-together sessions that we do on Thursdays, we had a case like that with a trade with Starbucks, which turned against us pretty massively for like 2 or 3 weeks, or I don't fully remember the dates, but let's call it 3 weeks. That stock was moving against us almost every single day, and finally started moving our way. And then what we were expecting to happen, it was happening exactly the way we expected it, a strong breakout. Okay, the only thing is that it happened at a different time, right? So what's the beauty with options? Well, you are just buying yourself time. Okay, that's what you pay when you buy options. You pay for time. You buy yourself time, right? So it's a pretty intelligent approach on how to do it, and it certainly produces a very, very powerful effect in your accounts. Okay, but of course you need to know about options and you need to know how to trade them, which in this room not everybody trades options. Okay, and putting on the side that it would be very healthy for all of you to master options, because it's an amazing instrument. Well, the fact is that we all have priorities in life, and we are all busy people, and etc., etc. And some of you are invested in ETFs. Okay, and again, it's not the end of the world if an ETF goes against you and goes back to you 2 years later while you get paid dividends. It's not the worst. Okay, even though it's far from ideal. Okay, and personally, I'm not up for it as a trader. I like to be more efficient with my capital. Is that making sense? But I could understand that some of you have a very passive nature on how to invest, and there's nothing wrong. Okay, so I'm just giving you choices. Okay, even though I cannot help it and also reflect my own trading personality, and therefore, I mentioned the word option, and then I got a smile on my face. Is that making sense? But at the same time, ETF could be a valid choice. So now what's important, and the reason why, again, I'm spending time with this topic, is because what you don't want to do is to be rigid with your timing with stocks, because it's very frustrating if you were to be a trader who decides to buy JCI or IBM or Facebook or you name it, okay, and you get into the trade, you have a very well located stop that in your mind is a very good position. You did a volatility calculation, you calculated a multiple of an ATR, you did whatever, and you are in your mind, you are very, very sure that you are not gonna get stopped out because you gave yourself plenty of room and blah blah blah, and then you do get stopped out, and then it does go your way. It's very, very bittersweet as a feeling, and it leads to revenge mode, it leads to emotional trading. So again, don't be too hard on those stocks. They are fragile little creatures. we need to be demanding with our trading methodologies on how to time the markets, but we also need to be understanding of the nature of the products that we trade. And I will say it one last time, stocks are fragile. Okay, so you need to surround yourself from those tools to make your life a little more relaxed, to give yourself wiggle room, to be able to absorb vibrations in the marketplace until a market picks direction in a very specific direction. Okay, so hopefully I have made my point, because I did repeat myself. I did talk about this last week, I did talk about it last Thursday, and today talk about it again because it's critical. Okay, you know, in the sessions that we conduct together, I always combine, of course, the UFOs. That's obvious, and sometimes I don't even say it, but the UFOs are always there. I combine the UFOs with whatever topics that we address, whatever training that we do together, like, you know, maybe options. Bojan is saying that you're learning options, so could be options, could be futures, you know, and that's nice, right? And it's educational and all of this, but you know what? It's not enough. The one thing I always add on top of those two elements, okay, the UFOs and whatever support from an educational point of view I provide for you guys, what I always add on top of it is trading psychology. Always. Okay, and many times some of the rules or some of the actions that we do in trading are not to increase our probabilities, but are to deal with us being the fact, knowing that the fact is that we are human, and as human people we are emotional beings, and we all know, especially if you have traded before, and if you don't, you know it too, but you haven't seen it on yourself yet. We all know that trading is such an emotional game, and many times many big mistakes are done because of the emotions. So again, trading stocks with tight stops, with a too perfectionist as a mindset, with a very, very, very strong belief or conviction that, yes, my stop is in the right position, is no way I'm going to get stopped out. These kind of mindsets lead to problems. But problems, I don't mean that you lose one trade. Problems, I mean that you get frustrated, you lose confidence, you get emotional, you get in revenge mode. All those psychological side effects or consequence, I should say, of being human. Okay, and it's always very, very important that we keep all of this in mind, and that's why sometimes I have these long conversation and talk about something that some of you are thinking, I know that already. I know, yeah, but I need to remind you. You know, it's kind of, I mean, at least I appreciate it. You know, when I was learning how to trade myself. And again, I know some of you are experts already, but some of you are in learning stages, isn't it? So it's kind of like, you know, I remember when I was being advised by someone, what is one of the best things that parents can do with their kids, and being Father's Day, maybe it's a good day to talk about it. And one of the things was repetition, right? So when you are teaching your kids to do something, it's not enough that you say it once and that's it. You have to repeat, right? And sometimes, especially at certain ages, it will be like, you know, it's almost like they cannot take it anymore on how many times you have said it, right? But then fast forward in time, when those kids become adults and now they have certain habits in life, they look back and they look at their parents and be like, oh my God, repeat works. Thanks, Dad. Thanks, Mom. Is that making sense? So it's kind of the same in trading. Okay, there are certain concepts that we have this tendency to forget very, very often, very quickly. And that's why there will be times where I will repeat certain things. And if you see me repeat, okay, you know why. It's because it's important. Okay, and we need to build that muscle memory. Anyway, let's keep going. Okay, because we have a lot of stuff to cover here. So let me take a look at your comments. Lisa, good question. What about USO and the contango effect? Yeah, ETFs got price decay, isn't it? Okay, and we talked about it last week. ETFs got price decay, especially the ETFs that are made of futures contracts, such as commodity ETFs, such as UFO, which is the oil ETF, isn't it? Reading you, Ahmad. So obviously, in those ETFs, this concept of holding them, waiting for them to come back, it's certainly not ideal at all. Okay, so definitely with equities, you know, it's, let's call it okay. even though there is some price decay too, but there is less, and also you have the dividends payments. But with the commodity ETFs, I mean, with most of them, unless they are a mix of commodity, like for example, XOP, XOP is an ETF where you got oil and gas exploration and you got commodities, but you got companies as well. So you may get some dividends in those, so it's okay. But if you get a pure commodity ETF like UFO, then I would certainly not recommend to approach those trades without the use of options, okay? Because on top of that, I mean, let me add one more thing too. Okay, and thanks for the question, Lisa. Very good question. So take a look at, for example, SPY. Okay, look at the performance, 51.75. Okay, and that's SPY. Okay, now let's take a look at ES, which is the S&P future, 24 hours versus 6 hours and a half. You got 62%. So why is that market? They are the same market, right? Both are the S&P. Why is it that future is giving you a better performance? Because it's 24 hours, where SPY is not 24 hours. So the data you have on the screen is partial data. Okay, you got 3 times less data than what you have in at ES, which is 24 hours. So no wonder why the performance is less, because I mean, TradeStation doesn't know what it doesn't know. If you type SPY, it's gonna process the algo for SPY, but the fact is that SPY has 3 times less data compared to at ES. So just because of the fact that you got less data when you compare futures markets and ETFs, that already reduces your probability. But on top of that, when you use commodity ETFs, right? For example, gold, GLD, I mean, it's not a small market, right? But take a look at the 51%. The 51% becomes now what? 39. I mean, that's terrible. Why is it so low? Well, very simple, because in the S&P futures or the SPY, even though we just talked about you got 3 times less data, is only 6 hours and a half a day, at least, even though you have 3 times less data, the data you have is very relevant, because the on-field orders placed in the market during US market hours in a US index market such as the S&P, that's relevant. Even though, of course, you could have an Asian institution placing an order at 4 a.m. US time, and that order is just as relevant as a US institution. But the fact is that just because it's a US market, etc., and is obviously heavily traded in the US during the US time zone, then that SPY data is very relevant. But that's not the case with gold. That's not the case with oil. Okay? The relevance of the US time zone for equities is clear. But the relevance of the US time zone for gold, oil, etc., is not clear at all. Actually, as you can see, just by looking at those stats, you now know European time zone UFOs and Asian time zone UFOs are actually stronger than US time zone UFOs for gold and oil and markets like that. Okay, and why is that? Because, you know, I mean, Australia, for example, is a major exporter of gold. Okay, and it's in Asia. So those UFOs are no joke, right? I mean, you get my point, right? So you have 3 times less market data. The market data you are missing is very relevant on the commodities. And on top of that, you have the price decay, which is very strongly influenced by contango or backwardation scenarios in the futures markets. So long story short, Lisa, thank you for the question. Holding commodity ETFs, hoping for the best for a very long time, it's not ideal at all, okay? And I would not recommend you. And if you wanted to be exposed to those equity index markets for a longer time, you should certainly open the door to using options to do this in a way that is much more powerful. Now, you tell me, hey, but I don't know. Okay, so then do a little variation. Maybe you use ETFs such as XME. Like XME is metal and mining companies. So what's the beauty of this ETF? You got companies, and therefore you'll get some dividends. Yes, everything I said before is true. You still got price decay. You still got, you know, all those problems. But notice the performance. What's happening with the performance? 57%. Why? Because XME is related to gold because it's made of stocks and products that depend on gold and diamonds and silver. So in other words, it's related to equities more than the commodity. It's indirectly related to the commodity, but it's more equities, right? So those ETFs, I would say, could be okay, but the ones that are purely commodities, okay, you should either use futures markets to trade them, or if that's too big because of the overnight margin or because of the leverage, if that's too big, then you need to go the route of using options on those ETFs, okay? So again, Lisa, super, super important question. Bojan, Jose, any chance you may introduce a long-term investment get-together session once a month or twice a month? Yes. I could not confirm dates at the moment, but I do have that intention, and probably those sessions could happen around the market hours when the market is about to close in the US. So instead of doing like what we do with the intraday, where we do it before the market opens into the open, so that would be kind of the opposite. It would be into the market close, into the close. Okay, so we'll keep you informed, guys. But definitely, and thanks for that. You miss the do's and the don'ts. Okay, yeah. So to watch it is very simple. You come to. Let me show you. So YouTube, that's our channel, isn't it? And Magic, we started a new playlist called Basis for Trading. Okay, and if you click on that one, the first and only video for now is Do's and Don'ts in Trading, which is a 1 hour video, very foundational, very basic, okay, but also very, very important video of things for you to keep in mind in your trading. Okay, and since I am flashing YouTube, you guys, if you haven't subscribed or clicked on the bell, this would be a great time to do so, and also the thumbs up if you are enjoying the session. Thanks for that, guys. So very good. So let's keep going, guys. Okay, so now we got more stuff in the bottom part of this list, okay? But again, today we are supposed to be talking about how we do this, okay? And here's the big difference, okay? If you are, because remember, the rules that we apply to plan our trades for the long term are exactly the same as the one that we use for intraday. So the rules are the same, okay? But what's the difference? Well, if you're going to apply those rules to 9,000 stocks, you got 9,000 charts to watch. Where if you were to apply those rules to Forex or futures, and let's say you trade, 5 or 10 futures markets, then you have 5 or 10 charts to watch. So watching 5 or 10 workspaces in your TradeStation or TradingView, everybody can do that, even if you're busy. It's not a problem. But watching manually 9,000 stocks is crazy. So what do? Well, we use a scanner. We know that, okay? But at the same time, in this session and the prior week, we have been adding more. So if you recall, when I built this scanner for you, that's a few months back, isn't it? So when I built that scanner for you, we were not using the common time frame. We were only using one time frame, okay? And it was this one, okay? And it was a common time frame that we were using for entry, which was not ideal, even though it was not crazy, but we now made it better, isn't it? So now that we have made it better, it would make a lot of sense to take our scanner and take our scanner to the next level to actually represent this particular methodology so we can save a lot of time, okay? Because now applying the methodology, you now know, okay? If you were to apply it to stocks and you were to do it one at a time, you now know. So the idea would be to use the scanner. So the scanner gives us a list of all the stocks that meet that particular criteria, okay? And again, the scanning system that we had up to this point, if you don't want to change it, it's a good scanning system. But I'm just going to make it resemble the most I can to the methodology itself, so that way we have the least amount of wasted time when planning those trades. Okay, so I'm going to start with the directional long trades. Okay, directional long trades. So I'm going to click on format, and we got a lot of things here. Okay, we got many things. Okay, some of the things I'm going to keep them, some of the things I will change them. Okay, so for example, the moving averages, the way we had it, which is something that we did a long time ago, and again, it makes sense. Okay, it's not about decision. We were looking at the 21 at the time and the 34, and if the 21 was above the 34, we would call it an uptrend. Okay, where the methodology that we are using now, it's more powerful combined with the DMI. So if you think about it, here the DMI is using ADX, where here in the DMI we are using DMI plus and DMI minus. Okay, and here we are using an EMA which is 9. Okay, is the 9 EMA, where, you know, a long time ago when we had this very foundational initial approach to how to build a scanner, you know, we were using the 21 and the 34, which again makes a lot of sense, but now we can be more precise. Okay, so what am I going to do? Well, first I'm going to get rid of the moving average line. Okay, I'll get rid of this one. I will get rid as well of the one that is DMI, and I will also get rid of the one, the other moving average, and also the RSI. Okay, so basically, by getting rid of all of these, I am left with looking at stocks which are $15 or more. Okay, and you could certainly go for lower if you wish. Not ideal, because normally cheap stocks are not traded by institutions. Normally, not always, but normally is the case. Okay, and how do we know that? It's very simple, because if institutions were to buy stocks, I mean, institutions buy a lot, so price would go up, and those stocks probably would be higher than 15, correct? They would become $100 per share, $50 per share, whatever. So, you know, buying too cheap stocks is probably the sign of buying a low quality product, like what happened in most of the things in life, isn't it? So 15 seems to be a good place where to draw the line, and we could certainly vary that. Okay, but we'll leave it like that for now. What else? The average liquidity in the last 3 months, the average volume, okay, average volume in the last 3 months, we want it to be at least 500,000 shares. Okay, and that's what we have, and this we're going to leave it the same. Then we want also a minimum open interest in options of 100,000. Okay, so this is for all options. We want the total open interest to be at least 100,000. And you may say, wait a minute, what about if I don't trade options? Should I use that filter? Okay, and the answer is yes, you should still use that filter, that parameter in your filter, in your scan, because if a stock got no liquidity at all in the options world, it means that no one is buying options. And if no one is buying options, odds are that the only people trading the stock is the public. Okay, because the big hedge fund players, the big investment banks, believe me, they use options. So you would want to see some participation in the options markets in the form of open interest. Open interest means contracts that were born sometime in the past. So someone traded those contracts sometime in the past, all the way to today. And therefore, the higher the number, the more it represents institutional participation. Okay? So you want the volume to be high so you don't get slippage and you get good spreads when you look at the bid and the ask price. But you also want good open interest in options, because potentially it will make the options prices to be adequate, but also because it probably is like that thanks to institutional participation. Therefore, the UFOs not only represent on-field order, they actually represent on-field order that belong to someone who is a large market participant. And you certainly want to buy when the large market participants buy, and you certainly want to sell when the large market participants sell. Okay, so we're gonna keep that figure no matter if you trade options or not. Okay, and then the next one would be optional. Okay, optional in case you trade options or not. So if you don't trade options, you would just uncheck it. If you trade options, you would check it. Okay, but I would recommend you to have it there. just in case sometime in the future you trade options. And in this case, what we're dealing with is we are dealing with stocks where the implied volatility, okay, of that stock, okay, is in the bottom 50, meaning that out of stocks that meet those criteria and the ones that we're gonna add, those stocks are located in the bottom 50 range, and therefore we are dealing with stocks that meet certain conditions that do show some of the cheapest options out there. And we love cheap options because remember, when you buy options, the most you can lose is what you pay for the option. So you like it to be cheap because that way, if you lose cheap. If the option was to be expensive, okay, putting on the side the problems with options pricing, which you may have the stock move your way and the option is not gaining value because you purchased the option and it was expensive already. But putting that on the side, which is obviously a major consequence that would be terrible, putting that on the side from a risk management point of view, if you buy a very expensive option, then the most you can lose is an expensive value. Okay, and we don't welcome that. We want to risk little in exchange to make more. So therefore, in this filter, we need the word bottom, and you would check mark or uncheck depending on if you use options or you don't. Okay, but I want to make this a little more efficient. Okay, because like that, to be honest, is good enough. Okay, but I just want to go just a little deeper. So I'm going to add another indicator related to options, which is going to be implied volatility, all options, the same as before. Okay, and that one, now I will want it to be lesser than another indicator, okay, which is going to be V for volatility standard deviation, okay, which is known in the world of options trading is known as historic volatility. Okay, so you want the implied volatility, okay, you want the implied volatility, not the average, the implied volatility for all options. You want it to be below the historical volatility. This is not super important. The line above is way more important, but this is gonna kind of force the scanner to give us a little bit more extreme conditions when it comes to how cheap the options will be. Okay, good. So what else? Well, all of these parameters have to do with the selection of market symbols. In other words, out of 9,000 stocks in the market, which is more or less like that, I think it's more than 9,000, but let's call it 9,000. Okay, those filters will basically determine which stocks to pick without looking into step one, which is the market environment, which is what we do with our common time frame. Okay, so that up to this point we haven't looked into that yet. So we need to add now the conditions for the market environment. And what are the conditions? Well, the conditions are two. Okay, you want, okay, the close, okay, you want the close, and because I don't know if you will execute this scan when the market is open, or if you will execute this scan when the market is already closed. So what I'm going to do is I'm going to use the close of 1 day ago. So that way, no matter the time of the day when you execute it, because it's the close of 1 day ago, that value doesn't vary. Okay, so you will not get different fluctuations. Okay, also I like that because the implied volatility, this figure here, implied volatility all options, interest station is updated at the end of the day. So even though you are looking at the current value of implied volatility, it represents yesterday end of the value. Therefore, I'm going to look at the closing price of the stock as well, pointing at 1 day ago, and I will want that closing price to be above the moving average. Correct? So indicator, moving average, exponential. Okay, and let me expand so you see this better. Okay, so we are looking at a daily time frame, which is the common time frame. We are looking at the 9 period, okay, which is the 9 period. Okay, but wait a minute, we need to look at the close of the prior day, isn't it? We need to look at the close of the prior day. So here where it says close, okay, I need to use a little bit very super easy and simple programming skill here, which is instead of close, I'm going to type close and then between brackets 1. Okay, so close 1. That means the prior day close. So in other words, I want the close from 1 day ago to be above the moving average from 1 day ago. This is exactly one of the rules that we have to look at the trend. But not only that, we also have a rule based on the DMI. So we look at the DMI. Here's the DMI. I click OK. Okay, and we want the DMI plus to be above the DMI minus. So I will insert another indicator, DMI, and now instead of plus, okay, here carefully I need to select minus. So DMI plus above DMI minus. Okay, so if you run this, you will end up finding stocks that are above the average, okay, above the average with the DMI strong. Okay, so remember, this is not a set condition. You could trade to the long side with a weak environment, okay, which is, you know, here we had an example where you got red, okay, but the close is above. Okay, you have this contradiction. Remember when we talk about contradiction? So above is above, but below is red. Okay, so that's a contradiction. Okay, where now above is above, but below is green. That's not a contradiction. So that means the condition is strong. So again, since we have so many stocks, I don't need to worry about, you know, let's pick stocks with a weak condition. There are so many that normally I'll be okay to find strong conditions. Okay, so now that I got all of these, okay, I'm just gonna click OK and run, and we're gonna run this scan and see what the results will be. And while this is happening, we'll talk about this. We're gonna have a 5-minute break, and while this is happening, you know, we'll be on break, and then we'll talk about it, okay? And we'll go deeper into this process. So, you know, we're gonna build super powerful scans here for what we do. So, guys, talk to you in 5. See you in 5. See you in a minute. Bye bye. Okay, everyone, we are about to restart in like 30 seconds. It'd be great if you could give me a confirmation for the sound check. So please, on the chat box, on the comments box, go ahead and type anything that comes to your mind that denotes that you heard me. So I know that you're ready to restart, so we can do it. Very good, everybody. So we are ready to get started. So Lisa was asking, can you please repeat the logic for scan to get the prior day? Yeah, the logic is quite simple, to be honest. The logic has to do with being able to run your scans during the day, no matter the time, and get stable results where your list of symbols don't keep varying. And it's not only about convenience, which that would be convenient, but it's also about the fact that it actually represents what the methodology suggests, isn't it? Because what the methodology does is to ignore the prior close, okay, and focus on the close ignore the current close and focus on the close before. And the methodology also implies to ignore the current average and focus on the prior value of the average, isn't it? So therefore, that way on how to scan would be 100% aligned, with how we do it. Okay, so that would be good. So anyway, so here's the list that we got. Okay, and out of curiosity, I would like to look into AMD. Okay, and see what we've got. Okay, well, interesting, isn't it? It's exactly what I wanted to explain, and it happened in the first example. So again, using a prior day close, it's very convenient if you run the scan during market hours. But if you run the scan when the market is closed already, really the problem is that prior market close refers to this candle that was above the average. The problem is that when the market opens and a new candle begins forming right here, right? So the prior market close will be that one, okay? And that obviously would be a downtrending condition. But again, it's not a big deal because look at what's happening here, right? And since the scanner is looking at both, okay? So then we are pretty okay, okay? So yeah. So let's do it. So AMD, okay, 55-minute time frame. You have your UFOs, you have your moving average. If you look at Amazon, okay, same thing, prior close above the average, okay, and DMI is green. Okay, so you see, by scanning this way, you are just gonna save a lot of time because automatically you are being given those results, okay? Now, for my case, in my case, because normally when I conduct the sessions, I run the scans before the market opens. So as the market opens, I'm ready for it. So what I'm going to do is I will not use close 1 day ago. I will use a close. Okay, just close, not 1 day ago, just close. And when it comes to the moving average exponential, I will not use close 1. I will just use close. Okay, and the reason why I'm going to do it like that, I just said it, is because I run the scan before conducting the get-together sessions, which happens to be when the market is still closed and hasn't opened yet. So therefore, the close is that candle, okay, compared to that average, okay, which will be the prior candle the moment a new candle begin in here when the market opens, okay? So hopefully I didn't confuse you too much, okay? And that's gonna be the scan that we're gonna use for directional long trades, which is gonna be just a little more convenient than the one we had before. The one we had before was great, no problem with that. It was certainly helping to stack some odds in our favor, but this one is gonna be even more convenient because now you will not have cases where you look at this chart on the left and you're gonna be like, oh yeah, but I'm already below the average, things like that. You will always have situations that meet rule number one. Okay, so you save time. So now for directional shorts, okay, we're gonna do exactly the same. Now, just to save a little bit of time, so what I'm gonna do is I'm just gonna copy the name of the scan, and I'm gonna delete it. So I'm removing the short, okay, and I'm gonna go ahead and right click, copy scan, right click, paste scan. Would you like to keep it? No. Okay, and I got a new directional long. I'm gonna rename it. I'm gonna call it short, and now I'm gonna format it. So it's gonna be very simple. All the parameters on the top are the same, and the three in the bottom, actually yes, and the three in the bottom will be different. So we don't want the close above the average. We want the close below the average. And we don't want the DMI plus about the DMI minus. We want it to be inverted. Okay, so if you reverse those two guys in the bottom, okay, and you click OK, and now you click Run. So magic, we now have the directional long and the directional short scans running. Okay, and again, good news, those scans represent exactly, okay, what we do as step one. So you are saving now significant amount of time, and you are just a little more perfectionist now with the price of the options too. Okay, so that scan is an improvement of what we had before. Okay, Mr. Vincent, is that possible scanning on Forex? If so, what the steps and settings? Okay, so the steps will be exactly the same, but you will just remove the options data, because there is no options data with Forex. So you would use the same scan, long and short, okay, and you will remove the options data, and then you would have your Forex scanner and your future scanner as well. You can do it too, okay? Again, with Forex and future, I think it's not even worth it to do it, because there are not too many currency pairs, and it's very easy to switch from chart to chart. I mean, like, if I was to open the Forex markets here, I'm opening the Forex layout. So let's say you are doing Forex daily, okay? You click on that one. It's gonna be 5 charts opening, at least the way I have it set up. You may not use reactive, and therefore you only have 3. That depends on you, of course. But the way you scan is very simple. On TradingView, and you can do the same on TradeStation too. I have my little list of currencies. I have them sorted as Forex majors. Then I have my Forex minors, okay, and then I have my exotics, okay, and then I also have those are exotics, but they are tradable, where there are other exotics that are crazy to be traded. And then I have my Forex all. Okay, so what would you do? You would start with majors, okay? And the only thing you do is to look at the upper chart. So you would just click Australian dollar, and you can quickly see if you are above or below the average, right? So you know what to do. This is a short. Let's say you are looking for longs, so you just keep going. This one is below. What about the pound? This one is below. What about the New Zealand dollar? That one is below. What about the Canadian dollar? That one is above. So what do? Now you begin planning the trade, okay? And this really takes no time. So I personally, for Forex and futures, prefer not to use the scan. But if you wanted to use the scan, it would be exactly the same thing. The only thing is that you would remove the 3 rows relative to 2 options, okay? Now, to the short eye, we ended up with 4 market symbols. So for example, let's take a look at Tiffany's. Should be in a downtrend. So let's see if Tiffany's in a downtrend. Look at that. Tiffany's in a downtrend. Prior close below the average. DMI is red. Okay. So now, of course, you need a red UFO to take action. and this is to be checked manually. But again, out of 9,000 stocks, the scan ended up giving you the 4 stocks that meet our rules, that are giving you an edge even before you plan the trade. Okay, and therefore it's a very good beginning, very healthy beginning for you to execute, okay, with those stocks. Okay, so anyway, we got the new version of directional long and short. Okay, but okay, we also talked about fundamentals. And the other day I was talking about the difference between being a trader and being an economist, in a very simplistic fashion, by the way. And we talked about the importance of fundamentals because of the time exposure, but at the same time, doing proper fundamental analysis would imply learning serious economics, and then it would be such a tedious task, to be executed to end up with some okay result. Okay, so I would like to provide you with a process, okay, quite simple process, okay, a process that is quite simple, on how to potentially do this fundamental analysis in a way that is built in the scan, and that way you end up with a powerful result while you keep it crazy simple. And if you don't know anything about fundamentals, you kind of, I'm about to say something half incorrect, but you kind of find yourself in a position where you kind of ignore fundamentals even though you have fundamentals on your side. Okay, so that's the approach I'm gonna share with you, looking for that pragmatic approach to trading. Okay, pragmatic means you put 20% of the effort but you get 80% of the result. That's pragmatic. So very little effort when it comes to fundamentals, but get most of the effect of fundamentals in your trade while you have your trend, your UFOs, your everything that we do. Okay, so how we're going to do this? Well, I'm going to propose to you guys to use something called the PEG ratio. Okay, you're going to be like, why? Okay, especially if you have certain preferences in fundamentals, and especially if you are very well trained in fundamentals, you could certainly ask me that question, and then we would need like 2 hours to talk about it, which, today would not be the right day to do so. But let me give you a quick answer to the question, why PEG instead of EPS, or why PEG instead of, margin ratios, or why PEG instead of whatever else. Okay, and the reason why is very simple. So if you look at the formula of PEG, okay, in that fundamental ratio, that formula is taking into consideration what the price of the stock is compared to the earnings per share that were produced. Okay, so this kind of gives you a quality, if you wish, because if the price of the stock is very little, very, very low, well, that ratio will go down, isn't it? The ratio will go down. If the price of the stock is, let's call it average, but that company produces huge amount of earnings, okay, well, then that number is going to be very big, making the number on the left, making the result of the division to be a smaller number. So either because the stock is cheap or because the earnings are great, the ratio above, okay, would be a small number when things are good. Okay, but also, and here's what's interesting about the PEG, which is the G. Okay, you have the EPS growth, which that's going to be a prediction. Of course, we cannot know the future, but it seems that the managers of that particular company are envisioning certain level of growth that they are quantifying in predictions for future EPS reports. And that is accounted into the formula. In other words, if they expect a lot of growth in the future, then you're going to have a great number dividing, in this formula, making the PEG ratio to be small. In other words, the PEG ratio will be small if the upper part is small. Sorry for that. The PEG ratio will be a small figure if the upper part is a small one, or if the bottom part is a big one. In other words, if the value of the company is very, very, very good, you'll get a small ratio. And if the value of the company is average or whatever, but you have a lot of expected growth, which should help for the stock to go, then the PEG ratio should be small. So in other words, a small PEG ratio tells you something good about the present and potentially something good about the future. Again, it's an expectation, it's a prediction, it's fundamentals, it's not a guarantee. But if you got 9,000 stocks in the market and you need to pick a few, and magic, the few you pick got all the parameters in place, and on top of that a better PEG ratio, well, that would be a better pick that potentially will provide better odds for you, because for the long-term investments you got a lot of time exposure, and therefore if those fundamentals are true, they may translate in price movement of the stock in the direction you expect. Okay, so what would you do? Well, key takeaways. Let's read this together. The PEG ratio enhances the P ratio by adding in expected earnings growth into the calculation. The PEG ratio is considered to be an indicator of a stock true value, and similar to P ratio, a lower PEG may indicate that a stock is undervalued. Okay, the PEG ratio for a given company may differ significantly from one reporting source to another, depending on which growth estimate is used in the calculation. That's the subjective part, isn't it? Because there is a prediction, there is an estimated expectation for what that growth will be. 3-year projected growth. By the way, there are different PEG ratios and stuff. But again, I don't want to make this complicated. What's key is the G, growth. Okay, I believe, and I'm not an expert in fundamentals, but I believe that the PEG ratio is one of the very, very, very few ratios in fundamentals that take into consideration growth. And even though it's a prediction or an estimation or whatever, and it's not going to be precise, well, let's face it, the EPSs are not precise either, because almost every time the CFOs of companies report EPS, and 3 weeks later they correct the figure because the figure was not reported properly. So even though it's not a prediction, it's not accurate either. So since it's not going to be accurate anyway, so you get my point, isn't it? So that could be a valid way on how to add some additional filtering into the formula. And so now, of course, fundamentals, if we apply these to a common time frame daily, I would say it doesn't make much sense. Okay, it doesn't make that much sense. Why? Because fundamentals is an external force that may impact the stock sometime, but we don't know when. So when you put fundamentals into the equation, you want to give yourself plenty of time for those fundamentals, if they're going to help, to give fundamentals the time to help, right? You don't want to be in a trade which is 10 days, 20 days, 30 days. You want to be in trades which are longer lasting. In other words, the scan that we're going to build now that includes fundamentals into the equation, will also involve the use of the weekly time frame, combined with 144, which is the next combination of time frames. Weekly and 144. And you can certainly do monthly 377. I will not do it because I think that would be good enough, but you can certainly do it as well. So but don't go below weekly if you're going to be using fundamentals, because then really it doesn't make sense. Remember, it's expected growth 3 months later, so you certainly would like, that would be a case where you should be open to be exposed to those trades through earnings, because in those futures earnings, that growth may be reported and the stock may react to the growth. Is that making sense? So now we are talking about you using the weekly time frames or even the monthlies, where in the prior 2 cases here, we were using the daily, and therefore it made no sense to add fundamentals into the equation. So what are we going to do? Well, I'm going to go ahead and click on directional long. I'm going to copy the scan and paste it again. Yes. So I'm going to give it a different name. So we're going to rename it. And instead of directional long, we will call it investor long. And in this case I will not even add the D, because in those cases you may go ahead and utilize let me say that again, utilize stocks themselves or ETFs as well without without options. Okay, because remember the concept that we covered earlier. Maybe you want to be exposed to dividends and so on, which, by the way, we're going to add the dividends into the scanner too. Okay, so I created my investment long here. Okay, I have it. Okay, actually, let me rename it just out of convenience. If I was to do this, yeah, so now I have it here on the top. Okay, just because all those trades, directional, neutral, and non-directional, is quite active, where investing is not. So I'm glad to have. I just pushed it up. Okay, so investor long. Okay, now format this. Okay, and now what are we gonna change here? Okay, well, first I would like to raise the value of the stock, okay, to 25 instead of 15. Okay, why is that? Well, because you want to be far from zero. In other words, if you're gonna collect dividends, if you want to, if you're gonna be holding a stock that potentially went against you because fundamentals are in your favor, and ideally they would push the stock in the right direction, etc. Well, in case that's not the case, you want to have a little bit extra buffer. And because this is long term, one consideration would be to raise the price of the stock by a little bit. Second consideration would also be to reduce the amount of trading that is available. Okay, why? Because in this case, when a stock is moving very strong because of fundamentals, say for example a company has totally changed its fundamentals, went from a company that was so-so or not good to being a company that now is really doing well, and that becomes public. Now everybody will want to be invested because every market analyst will recommend that stock. So then that's going to drive volume. But when you identify that opportunity for yourself, probably the volume is less high than what it will be in the future if that is true. So in this sense, even though volume is always good because of avoiding slippage and spread, well, in this case, I'm going to consider dropping it to 300,000 shares, okay, just to give myself the opportunity to find more unique opportunities from the point of view of fundamentals. Okay, I want a longer list to be able to find those unique opportunities. If I'm too picky with the liquidity, probably those stocks already became an opportunity. That's why they are so liquid. So I am late. Okay, I don't have time to let those fundamentals play for me. So I'm just reducing the volume requirement. Okay, and I'm going to do the same as well with options. Even though in this case, I don't plan to use options, okay? In this case, we're going to be purchasing the underlying, holding it, collecting dividends, etc., etc. And you could certainly go ahead and go the route of options. But again, if we are opening the door for stocks that are going to be less liquid, probably that's going to make the options less liquid as well. So you get my point, right? So I'm just going to leave a smaller figure there, okay, which instead of 100,000 is going to be 50,000, just so I know I'm not the only guy trading that stock. Someone else is, okay? But I'm not gonna be so demanding with the open interest for options, because in this case, I am not necessarily shooting for options. You can certainly use options, but I am not necessarily shooting for options. Therefore, the two next filters, I will leave them there in case some of you plan to use options, okay? So you can check them again, so you can have the options, but I'm gonna uncheck them so the scanner will not take them into consideration, because again, the idea here is to trade stocks that are in a different place. Okay, now what else do we need? Well, we need the close to be above the average, but careful, the average cannot be in the daily, it needs to be in the weekly. Okay, so this is one change. Okay, same for the DMI. Okay, so we want the plus DMI to be above the minus DMI, but not in the daily time frame, in the weekly time frame. So I need to change those intervals to weekly. And by the way, I'm giving you detailed explanations of what I'm doing in case you want to replicate it for yourself or use a different platform. But I'll produce a file that I'll be more than happy to send you guys, and you can just import into your TrustStation, and you will have all of this already built in. Okay, so now I got my DMI with the weekly as well. okay? And the only thing that is now missing is my fundamentals and my dividends, okay? So let's begin with dividends, which are here, okay? And I'm going to look at dividend yield. Let me see, because there are many. Payout ratio. Yeah. I'm gonna look at the yield, and as an operator, I'm just gonna use display. Okay. Why is that? Because I don't want to have a rule where I look for dividends only 3% or greater. I mean, you could do that, but I rather have a whole list on the scanner that I can sort, and then kind of cross information in places and decide what's best for me, because there will be times where companies or the economy in general is doing very well and every stock is paying more than 3% a year, or there will be times where many stocks are paying 1.5% a year, and then you would have no opportunities. Okay, so I just want to leave it as display, and then I will play with the sorting capability of the scanner to sort that once the scan is complete, as you will see. So I'm just going to add the yield. It's also healthy when it comes to dividends to look at the yield average. So in the last 5 years, okay? In other words, is this a company that is paying yield since not too long ago, and then it was a complete disaster? Or is this a company that is quite stable when it comes to payments? Because that somehow has a indirect implication with the fundamentals. If a company has been paying the same amount of dividends or growing dividends in a way that is quite consistent, probably tells you that that company is doing something right in their business. That's why they have money to share with the investors. If the company was not doing too well, probably they would not be able to split so much of their profits in the form of dividends, because the company is suffering. So looking at the average yield is also useful. Okay, and finally, now we're going to look at our valuation ratios, looking at the financial strength. No, not that one. I think it's in the common. Yes. And here's our PEG. And for the PEG, I'm going to do the same thing, display. Okay. And by the way, parameters such as PEG, when I run it and TradeStation reports whatever figure they got, TradeStation is using Reuters as their database. But if you were to look at it into using Google Finance, Yahoo Finance, whatever other website, you will likely get different values. So again, it's not about the value, okay? It's about, out of a group of stocks, if you were to pick the one with, the lesser PEG or, below average PEG, it's good. Okay, remember, with the PEG is backwards. The lesser the number, the better. Okay, guys? So here we go. We have it. So what I'm going to do now is I'm just going to click on run. Okay, and we'll see what we get. This scanner is likely to be faster to run. You can see we got less iterations, okay? Because, it's looking at less things, it's running less indicators. The data that we get from the PEGs and all of this is coming from TradeStation servers. It's not data that you calculate locally, thanks to running code in your TradeStation. So it's a little less intense on your CPU, okay? So 50% already. We're going to just wait to see what the result is, okay? And then we're going to be able to work on this. And then we'll do the short one, okay? And then we'll do the short one. So 70%. Okay, almost 80% now. So we're just waiting, guys. It's going to be just in a second. Yep, Pareto principle. I hear you, Orlando. You're shooting for that 3%. Yeah, take care, Royce. So 97% now. Here we go. We got it. Okay. So what did we end up with? Okay. So let's go ahead and maximize my scan. we ended up with 80 stocks. Okay, 80 stocks. So how do we deal with this now? Because of course, I'm not suggesting that you're gonna go ahead now and look at 80 charts. I mean, to be honest, you could, because this is long-term investing. If you get into any of those, that's going to be for a long time, isn't it? But at the same time, that was not the purpose. The purpose was to narrow down a little better. And therefore, first, we're going to look at the PG. So what you would do is double-click on the header, and that would sort it out. Notice how there are certain stocks that got negative PGs, okay, negative PGs, below zero PGs, okay, and small values, okay. Other stock that got way greater values, okay. So that's not good. That means that either the price of the stock is very, very high based on fundamentals, or the earnings have been very low, or the expectation for growth is very low, right? Where the lower the number or negative, it's much more powerful, okay? So out of all those below zero PGs, okay, that would be, you know, in a very idealistic world, now you will want to look at the ones that may have the greater yields, okay, the greater yields. And here you can see, you can certainly copy and paste this in a spreadsheet as well and play with it there, okay. But basically here you got, you know, yields 1, 2, you know, whatever, and look at CCI. Recently is 3. The average in the last 5 years is 3. Okay, 3, 3, 1, 197. This is paying 2, but it used to pay 3. So I would not go for this one. That company is paying less and less, right? That company is paying less. That company is paying less. That company is paying more. Expedia, even though it's only 1%. Prudential, nice PEG. The average was 3%. Now they're paying 4%. Okay. So again, you will now handpick, and this is a little bit manual, because again, those values of 3 or -1, -7, it means nothing. Is that making sense? I mean, yeah, it means something, but it doesn't mean anything in the sense that is 4% a good yield, or it depends. You know, there were times in the markets where 4% was nothing, and there have been times in the market where 4% was a fortune, right? So if you look at these numbers, what would you say the average is? Okay, from here to here. Okay, what would you say is the average? Okay, like maybe 3% or something like that. So anything above 3, it's good. Okay, and you know, if you got a small PG and you got above average, okay, so now you have a good stock based on fundamentals that pays dividends nicely. Dividends have been increasing, which reinforces the fact that, fundamentally speaking, it may be a good bet. So now the key is to time it. You know what to buy. Now the key is when. And to know when, you will now click Prudential. You will be able to see that Prudential is, in a second, will be showing up in our weekly time frame on the bottom left. Here we go. So Prudential, okay, is above the average, okay, with the green, how do you call it, DMI, okay. So when the 144 chart shows up, you would love if there was one or more than one UFOs around the average, which is 98.35, okay, around the value for the moving average, which is currently 98.35. You would love it if in the 104-minute chart, which is currently pending data, okay, is downloading, you would love it to find UFOs around that price. Again, I'm going to repeat myself one more time. We don't need to be that precise with stocks because stocks are fragile, okay? But it would be very, very powerful if you had that sort of a scenario. So it's taking a long time. Let me check my download scheduler. Oh, that's interesting. I got nothing in the download scheduler, so it seems that it didn't. Okay, now good. So what do we have? We have said that the average was what? 98.35. Okay, 98.35. Well, I don't have 98.35, but the top of this UFO is going to be around 98 something, right? So 98.10. Okay, 98.10. So that's good enough. Now, 51.38 is by using regular session. What if we use pre and post? We got 44. So pre and post, not useful with Prudential. We'll stick to the regular session. We have a UFO around 98.10, which is more or less 98.35. Let's face it, if that stock drops by $1, okay, the moving average will drop by a little bit as well. So, you know, we are fine. Okay, that's a valid trade. You have multiple UFOs in your favor. You got it. Okay, that would be a valid investment where we are adding some fundamental effect, some dividend payment together with the methodology that we use. Okay, and if you wanted to reverse it, you can copy and paste. Yes. And what I want to do now is rename the scan. So that we're going to be investor short, which is less common. Okay. Normally investors focus on the long, not the short. But if you wanted to do that, well, now you would want the close to be below the average and the DMI plus to be below the DMI minus. And then the yields and the PEGs, you still display them. And what you would want to do is the opposite. Okay, you will want to do the very same exact opposite, which is you would want the PEGs to be great numbers, not small numbers. That would reflect a company that is in trouble, stock is about to fall. And when it comes to dividend payments, of course, you still want to get paid dividends, okay? But then you would not want to shoot for growing dividends. You will want to shoot for decreasing dividends by comparing the average 5 years and the current date, okay? So this is how you would deal with it, okay? And again, you know, I'll be producing a file, and if you want a file to get all those scans in your TradeStation, you can do that, okay? Orlando is talking about the free cash flow, which is an indicator as well that tells you the company generates enough cash for the capex programs and dividends programs, okay? Which is nice, okay? Which is nice, is a good addition. But what I will tell you, Orlando, at least based on my experience in these years, is that when you start adding too much fundamental information, in the end, you start getting too much contradictory information. So you need to have a peak, okay? So if you like the cash flow indicator, because it leads into this consistency of dividends, then I would say don't look at the 5 year. Okay, look at the dividends now because you want to know what you're going to get paid now. Look at the dividends now. Look at the cash flow for you to understand better the health of that company in the sense of cash flow, as the name suggests, and therefore you know, dividends to be distributed among the investors, and then keep the EPG because again the EPG has to do with growth, which cash flow has to do with now. Right, so again, you want the growth component because in the future earnings, if that growth becomes a reality, that stock is going to jump, right? I mean, potentially, you never know how the investors are gonna take it. But again, if the PEG is very low, it means that either the price of the stock is very low, or the earnings have been very high, and if they are very high and the next one is higher, it's going to jump. And if the price is low and the next ones are good, then it's going to jump. And normally the jump is going to be to the upside because the PEG was low. Again, not a guarantee, it's just fundamentals, okay? But that's how it would help you. And my observation throughout the years tell me that, you know, this is useful in certain instances. Of course, in the end, what's key is your UFOs, okay? You get into the stock just because of the fundamentals and you don't add a little bit of timing, okay, and then you know you are not going to end up in the very right position, okay, because you are off timing, even though you have a good product, but now it's going to take 8 months to begin moving in your direction. So to minimize the amount of time you have to wait to see appreciation if you're long or see the price drop if you're short, okay, you want to make sure you add the UFOs, okay, as well as the market environment analysis that we did with a common time frame, in this case weekly, okay, and never below weekly, to get advantage of the earnings, the fundamental effect, okay? Good, then I add a ROS indicator to compare it with internet interest rates and cost of money, and I check the current liability. Yeah, again, and Orlando, I mean, I'm sure that you can put in place a process which is way more evolved and betters what I have been exposing you guys here. But I just wanted to have something simple. Remember, pragmatic. So 80%, 20% of the effort, 80% of the result. Okay, and on top of that, you can run it in the scan to make your life simpler and be able to pick stocks that give you an advantage, and then you apply the methodology and you obtain your edge. Okay, perfect. So, okay. So what do we have? What do we have? Yeah, so we talked about all of this, okay? And basically, what I haven't explained is how to use options for damage control, which this will be subject of multiple sessions, because obviously this is going to be very advanced options applications, like really, truly advanced. Okay, so we actually even need to do sessions on Greeks and stuff before we go there. So this is going to be, you know, something that will take some time. So please bear with me and a little bit of patience there, because that's going to be very powerful. But obviously, it's like everything in life, you know, we need to give ourselves time to absorb it and learn it. Correlation and diversification. This is directly linked to risk management, and also, you know, the concept I exposed you to, thinking of diversification, not only like having different eggs in different baskets, but also diversifying in a way to produce continuous results. Okay, this is something that is not often addressed. Most diversification strategies are about, okay, I got 100K, so I put 20% in metals, 20% in equities, 20% in bonds, 20% in whatever. That's it. I'm diversified. Okay, and this is different eggs in different baskets. But you know, when markets move, most of those markets are shaking at the same time, and therefore you don't produce consistent results. So we need to talk about other ways on how to diversify. And let me tell you that apart from allocations and stuff like that, options again will come into this equation. And let's face it, guys, you know, the professional hedge fund managers are options traders, all of them. They not only trade options, they also trade other assets, but all of them, I should say all of us, trade options, right? And therefore, again, we're going to kill multiple birds on one stone as we begin talking about options more in depth and damage control. That's going to be linked with the diversification and the risk management. And all of this thing, it's one big, monumental, impactful thing. It's all related. Does that make any sense? And it all comes after what we covered up to this point. Meaning that now you know the methodology on how to time the markets, which is the one we started using in intraday. Now you know how to use it in the larger time frames, and you know which are the larger time frames. But you also know that the stock market is a little more fragile, so you know how to approach it, right? At the same time, we talked about fundamentals, okay, and so on. And you can also add this into the equation, okay? So we really did, I believe, at least that's how I feel. Hopefully you feel this way as well. Please share with me on the comments box so I can kind of measure where you're at and how good as a job I'm doing to help you, or how not so good as a job I'm doing. So that I would really like to measure that. So please share with me how is it going so far, and how do you feel this impacts you and helps you guys? Because again, we put time in place to all together, yourself and myself too, to get together over the weekend. Sometimes, you know, stealing a little bit of time away from our families and so on. And I want to make sure it's worth it. Okay, so I need your feedback here, guys. Okay, let me know, please. But anyway, we started with intraday. We got the rules. We apply it now to the long term. So we have progressed a lot throughout those months, right? We got to a place far, far, far away from where we started. In the end, if you think about it, it's all kind of the same. It's all about the rules. It's all about the UFOs. It's all about your discipline. It's all about you building skill. It's all about you practicing and building confidence. It's all about the same. But I do feel that we have progressed a lot, because now we got to a point where the conversations to be taken place starting from now on are very, 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 very advanced conversations where everything we're going to add is just to make it better. Because let's face it, if you just follow the rules that I've been sharing with you, I mean, some of you are, isn't it? And you know what happened? You follow the rules with discipline and you get results. And most of the times when some of you may have sent an email to us and said, hey, but you know what, this week it didn't go too well, you get deeper into the conversation and then here or there you broke the rule, isn't it? So, I mean, what I'm trying to say, and again, please don't get me wrong, because we're all human. Everybody in the group is in a different level in their training, their experience in the marketplace, their self-control when it comes to human emotions. So everybody's in a different place, but at the same time, you do what we have been learning, okay, and you start producing results, okay? So that's the bottom line, okay? So now, that's why I said we have progressed a lot. So starting from now on, the idea is to now keep taking it to the next level, okay? Now take it to the next level, that much control, okay? So you got into a trade, you're about to lose, okay, it's part of trading. But what if you could reduce the size of the loss? What if you gave yourself another chance in case it came back, you make some money? Wouldn't it be great to convert small losses into small profits? Imagine you take whatever your distribution of winners and losses are. Imagine you take 15% of your losses, and not only you remove them from losses, but you made them small winners. What would happen at the end of the year, right? It's a major, major impact, okay? Plus, not only your results, but also your confidence, because now you get 15% less losses, right? So again, everything we will keep discovering together, guys. It's again, we are building a group, UFO traders, okay, or as D. Hyde says, the ufologists, right? We are building a very, very, very powerful community of people with incredible skills. And the only negative, if you wish, statement I will make at this point is that, of course, to build that skill, it takes a little bit of time. And, we need to steal some of your time. You need to steal some of my time over the weekend to get together and make that happen, okay? But again, I see some of your comments in the comments box. I'm happy to see that. Of course, not all of you are commenting, which I understand. Some of you may feel it's quite personal to share about your results, but you can always feel free to send an email to us. Okay, sometimes it's understandable. You may not feel comfortable in a public chat box to comment deeper. Okay, but you can always connect with us. As I always say, if you're doing well, we'll be delighted to know. But if you are struggling, just don't isolate yourself, guys. Just speak up. We can conduct special sessions once we identify what your problem is, if that was the case, and help you to kind of break out of maybe a cycle or a pattern where, for whatever reason, some mistake is being made, something is not well done, not working well. And many, many times it's just because we haven't realized that small little detail that, when someone points at it, you're like, oh my God, now I get it, right? So again, it's not too complicated, but we all know that learning how to trade is a challenging thing to be done, okay? So we need to go over this process to reach the ultimate goal, which is consistent results, okay? Anyway, so let me see your final comments here because we're about to conclude the session. John, how can I find the Discord group? I don't. I have the link somewhere, but I don't know where I have it. Okay, so if anyone in the group is in that Discord group, if you have the link handy and you can type it, that would be very nice. If no one is sharing that information, John, shoot us an email, and I think I'll find that link and I'll send it to you. Okay, because I don't have it handy at the moment. Yes, Ahmad, absolutely. We'll be sending that scan for you. Yeah, Devan. Yeah, I hear you with the Starbucks trade. It was a great example. Okay, those are trades that, as your guide, makes me happy times two. Happy in the sense that, of course, it's always very satisfying If I give you a trade and you guys execute it and you make some money with it, obviously it's very satisfying. But beyond that, if that trade actually is a good example, a good lesson, a good experience to be remembered for life, and that will impact how you trade into the future, I believe Starbucks is one of those. Okay, so that certainly makes me very happy. Okay. Yep. Orlando Jose, my confidence has much improved in the futures and the options trading arena. Yep. I can see that, Orlando, and I'm super happy. And by the way, you deserve it, my friend, because you put time and hours. Okay. You guys need to know when Orlando is not live with us here, he catch ups with the recordings. He never missed one. May have missed it live and then made sure he made the time to catch up. Okay, so this pays. Okay, and therefore, Orlando, good job, my friend, and very well deserved, and super happy to see that. Cool. Yeah. Yeah. Very good. Okay, everyone. So we'll conclude the session for today. We will see you on Tuesday on our get-together trading session. Okay, and hey, let's keep up the good work, and let's stay connected, guys. If you need anything from us, again, quick reminder, probably you know this, but just in case, reach at tradewithufos.com. That's our email. And yeah, Lisa, and look at that. I love it too, because your statement there shows and denotes the business mindset that you have. Okay, the business mindset that you have. It's all about rate of return. Okay, and the way you're thinking about the trade, it's the way to think about the trade. Okay, so very good, wonderful, guys. Talk to you soon. See you on Tuesday. Keep up the good work. Okay, and remember, keep that discipline high. Take care, everyone. Bye bye.